Today we're going to discuss a strategy that is specifically designed for lower time frames. And when it comes to scalping, it's one of the toughest styles of trading. Scalping requires you to make quick decisions, perform fast market analysis, and execute your strategy with complete discipline. If you're choosing a trading style where nearly 90% of traders lose money, then you shouldn't rely on random or low-quality strategies. Instead, you need a well-tested, highly accurate trading strategy. And that's exactly what we're going to cover in this video. In this strategy, we're going to use liquidity across multiple time frames. If you're not familiar with liquidity, let me explain it in simple terms. A liquidity area is a price level where a large number of stop-loss orders and pending orders are placed. For example, this was a support level. According to traditional price action, the price is expected to move up from support. And in this case, the price did move higher. But first, it gave a fake move. That fake breakout trapped buyers, swept the liquidity of traders who had entered here, and those who had placed their stop losses below the support, and then the price moved in its real direction. This is what we call a liquidity sweep. And that's the exact concept we'll use in this scalping strategy. The first step of this strategy is to identify and mark the liquidity zones on a higher time frame. You can use higher time frames such as the 15-minute, 30-minute, or 1-hour chart. For example, this is our 15-minute chart. This is the key level where the price made a strong reversal, and it's also the most recent swing high. Because of that, a significant amount of liquidity is likely resting around this area. We also have a break of structure here. These two levels will act as external liquidity. In addition, there are likely many stop-loss orders placed around this level, making it an internal liquidity zone. Now, the price can either sweep this internal liquidity before moving higher, or it can sweep the liquidity resting above the main swing level and then continue its upward move. Here's an important point. This is our main swing high, also known as the higher high. Many traders may have placed sell orders here, so yes, liquidity exists at this level as well. In fact, the market has already targeted this external liquidity by triggering the stop losses of those sellers. So, can we assume that after sweeping this liquidity, the price will reverse and move downward? The answer is no. We should not have that expectation because the overall market structure is still bullish. In a bullish market, when the price targets the liquidity above a higher high, there's a greater chance of a liquidity run rather than a liquidity sweep. That's why, in this strategy, we won't rely on liquidity alone. We'll combine multiple trading concepts before executing any trade. At this point, the overall market structure is still bullish. So instead of entering immediately, we'll patiently wait for the price to sweep a valid liquidity zone and reach the upside target. Friends, in the next step, we shift our analysis to a lower time frame. We're now analyzing the 5-minute chart. Here, this is our internal liquidity zone, and this is our external liquidity zone. As we can see, the price sweeps the internal liquidity zone. In an uptrend, when the market sweeps internal liquidity, there's often a higher probability that price will continue moving upward. The problem is that many YouTube videos stop right here. They simply say, liquidity has been swept, so enter a buy trade here. Place your stop loss below the sweep and aim for a large profit target. Looking at such a huge target makes trading seem effortless, as if you've discovered a magic formula for guaranteed profits. But the live market doesn't work that way. Instead of relying on false expectations, we need to trade based on market reality. That's what leads to consistent results. Yes, the internal liquidity sweep has already happened, but you still should not enter a buy trade yet. Why? Because a liquidity sweep alone is not enough confirmation. In the next step, I'll explain exactly why buying here is a mistake and what additional confirmation professional trade ate for before entering a high probability trade. Now, as we continue watching the chart, the price drops even lower from this point. Friends, the liquidity sweep had already taken place, so ideally the market should have moved higher from there. But that didn't happen. Does that mean the concept of liquidity doesn't work? Not at all. Liquidity does work. So you might ask, if liquidity works, why didn't it work here? And why didn't we take a buy trade after the liquidity sweep? The answer is simple. The market structure on the lower time frame was bearish. Even though the higher time frame structure was bullish, the lower time frame was still bearish. A bearish structure tells us that sellers are in control and have a strong presence in the market. That's why we didn't take a trade based on the liquidity sweep alone. On top of that, a clear bearish trend line had also formed. So, does it really make sense to buy against both the market structure and the trend line? Absolutely not. Instead, we waited for the price to break the bearish trend line and show a change in market structure. That's exactly what happened next. The price broke above the trend line, the internal liquidity had already been swept, and the market structure shifted to bullish. So, should we enter a buy trade immediately? You certainly can. But if you want a better risk-to-reward ratio, it's much smarter to wait for a pullback before entering the trade. Next, the price pulled back and gave us a bullish confirmation candle. At the same time, a fair value gap, FVG, was also formed at this level. This is where we'll enter our buy trade. We'll place our stop loss slightly below the fair value gap, and our take profit can be set at the previous swing high. As the market moves higher, the price reaches our target, and the trade is successfully completed. This setup delivers an impressive 1-to-3 risk-to-reward ratio, which is exactly what we aim for as disciplined traders. So, what did we do? We combined higher time frame liquidity, market structure, trendline break, change of character, fair value gap, and a bullish confirmation candle to execute a high-probability trade, instead of relying on just one concept. Let's quickly recap the entire strategy. In the first step, we analyzed the higher time frame and marked the key liquidity zones. Then we switched to the lower time frame and waited patiently for a liquidity sweep. However, we didn't enter the trade immediately after the liquidity sweep. Instead, we waited for the lower time frame market structure to shift from bearish to bullish. Next, when the price returned to the fair value gap, FVG, we still didn't rush into the trade. We waited for a bullish confirmation candle before entering. According to the smart money concept, SMC, some traders may choose to enter as soon as the price taps into the fair value gap. But for added safety and a higher probability setup, we waited for bullish confirmation. By combining higher time frame liquidity, market structure shift, fair value gap, and bullish confirmation, we were able to complete a high-quality scalp with an excellent 1-3 risk-to-reward ratio. Friends, this strategy may look simple, but it comes with a few important rules that you must follow. Rule number 1, always trade with the market structure. If the higher time frame is bullish, you should only look for liquidity areas where the market sweeps buyers' stop losses. After that buy-side liquidity sweep, you can begin looking for a long trade setup. Now, if the higher time frame is bullish but the lower time frame is bearish, don't enter immediately. Instead, wait for the lower time frame to change its bearish structure into a bullish one before considering a buy. The key is alignment. If the higher time frame and lower time frame structures are not in the same direction, it doesn't matter how attractive the liquidity sweep looks, you should avoid the trade. Only when both time frames are aligned should you look for an entry. This simple rule helps you filter out low probability setups and focus only on trades with the highest potential. Rule number 2, never take a trade without an important point of interest, POI or area of interest, AOI. You should never enter trades at random price levels. Every high probability setup must form at a significant technical area. An important POI can be a strong order block, a valid fair value gap, FVG, a key supply or demand zone. Only execute your trade when the liquidity sweep occurs at one of these high-probability locations. This helps you avoid low-quality setups and significantly improves your trading accuracy. Most losing trades happen because traders enter in random areas without any meaningful confluence. Professional traders wait for price to reach an important POI before looking for confirmation. The best part is that this strategy is universal. It can be applied to the crypto market, Forex market, Indian stock market, and many other financial markets. Practice this strategy consistently. Follow the rules with discipline and focus on high-quality setups instead of taking every trade you see.